Homland. Today is June the 11th, 2021. And if you're just joining, can you make sure to go on mute? There's a little bit of an echo coming in. Can I recruit somebody here to let people in that are in the lobby, and also somebody to go around and mute people who are not on mute? Somebody from the real estate leadership team is on. Can you please do that? And today, unfortunately, we had the person who was lined up to be our guest speaker. They can't.
You are muted.
Daniel, we cannot hear you.
All right. Can you hear me now?
Yes.
Okay. So I think somebody muted me. All right. So in case nobody heard what was going on here, welcome to the Real Estate Investment Education Club at Intel. My name is Daniel Homland. This is June 11th, 2021. And I am putting a link into the chat right now. My interface is freezing again. Well, maybe I'll just talk. Can you still hear me even though my interface is frozen?
Yeah, I hear you.
Yes.
Okay.
Yes, we can hear you.
All right. And could somebody let the person in the lobby in? It puts up a dialog box that freezes on my interface and doesn't go away until somebody lets it in. Lets them in.
Same thing happened to me. I tried to admit, but it is continuously spinning.
All right. This is frustrating. WebEx didn't have any of these problems. Okay, well, when I can, I will drop a Google form into the chat window. It's just a little 3-question survey on how do you actually connect to the real estate club? Do you go through meetup.intel.com? Do you add it to your Outlook and then launch it from there? Do you put the URL directly in your browser? Or do you do something else? And that would be really helpful to me because we've had an uptick in the number of people that have emailed me and said they're having trouble connecting. And I don't have a good way of troubleshooting that. So I'd like to know just how are people doing it? And the other 2 questions are around what topics you'd like to hear and what have been your favorite topics in the past. So my interface is still frozen. I may have to leave and come back in order to share my screen. So I will do that and I'll be right back. Hello, can you hear me?
Yes.
We're definitely having technical problems today. Hopefully you can see my screen also.
Yep, we can.
All right, perfect. I am going to drop this link into the chat, hopefully here, and I'll let you guys fill it out. Oh, this is coming up again. And I'll start talking about 1031s while the interface is trying to keep up. First of all, does anybody have any opens? Any topics that they'd like to talk about? Questions? Maybe we'll answer some of the questions at the end. But is there anything that anybody would like to say before we get started?
Is this forum anything real estate?
Yes, anything real estate.
I'd like to understand. So, I'd like to understand nationally what's going on, because I feel like what we have is kind of an unstable escalation of prices around the nation. And I just want to know if anybody has any understanding of how we would ever reach an equilibrium. Are people borrowing beyond their means? Is this a reasonable, appreciation of how home prices? Just kind of a general understanding of when we reach an equilibrium, is this thing going to continue to grow and grow? But it's just kind of unbelievable how the housing prices are continue to go up, at least in my zip code and for others that I've talked to around the nation.
Yeah, it's definitely going up nationwide. And maybe what we can do for that is we can set up a discussion group for that, simply because I tend to be, I don't like to get into political topics for obvious reasons, and it'll probably get there fairly quickly. And so let's set up a discussion group. We can do it for Friday of next week, and we'll just have an open forum for people to discuss.
Thanks a lot. That I appreciate it.
So I have a little bit of input on that. There's this video from Rare Birds, which is a RIA group, and they did an analysis on the market in the Oregon market, essentially, on the supply and demand. They have a YouTube video for May, so you can try to find that video on YouTube, and it kind of gives you a rundown of why the demand is so high versus the current supply. So
if you're able to find that video, can you drop a link
Yeah.
in the chat?
yeah, if
Thank
I can find that video.
That'd be great. All right. And
Question?
I also, oh, go ahead.
Through real estate, how we can get some tax breaks?
That's the topic of this,
basically-
or at least a topic here.
Oh, okay. So basically, to avoid paying tax and invest in the real estate.
Okay. One of the other topics that I've been thinking a lot about recently is how to set up an estate plan. So how to hold your real estate, how to minimize your taxes, how to potentially leave it to heirs, how to set up a trust, do things like that. So that is coming as a topic as well.
Thank you.
All right. Any other suggestions?
Hey Dan, this is Ashish. I had a couple of ideas. One was if we can send a calendar invite with the Teams link rather than a link to the Yammer page or whatever it's called, that would just make it a little bit easier for people looking to attend.
Yeah, the problem is that the meetup.intel.com manages the tracking of all the people that are coming in. It automates all the emails going out. It's my distribution list, and it's the one that Intel HR has approved. And so usually if you let's look at that actually right now. If you go to, let me pull up my browser. If you go to meetup.intel.com and you find the REI Club page, you'll see that follow button over on the side. When you click on that and you get a meeting link or a meeting request, over on the side for each event, you'll see the launch button. And that launch button should have the Teams link in it. You can even right click on it, copy it, and just bring it over to your browser. So the Teams link should be there.
Doesn't change every time.
But feel free in the form that I put into the chat to leave me feedback on what's not working for you and what is working for you, because I really would like to improve the process, and I don't have good visibility. First of all, meetup.intel.com does not give me good visibility into what you are receiving from it. It formats the email. It does a lot of things and never gives me visibility into it other than giving me a send button. And then also, I don't know, how you're going about and using that. So please give me feedback back in that form, and I'll read it and try to improve the process. All right, let's get started with 1031 exchanges. So I think all of you know a little bit about me, but some of the poignant points here. I'm an electrical and computer engineering major. I traded bonds to the Chicago Board of Trade for a year down in the 10-year note pit. I Overseas, I was a hard money lender for a number of years while I supported my family at a charity that we worked at. And then I moved back to the US in January 1st, 2010, just after my daughter had been born, and joined Intel that year. And then in 2008, I started my real estate company, which I use as a vehicle for my own personal real estate, but also getting other people involved in buying real estate as well. All right, so here's what is in this talk. First of all, we're going to give you an introduction to what a 1031 exchange is. We're going to go over the easy rules for a 1031 exchange, and then some of the more difficult rules that you have to adhere to. The IRS is very particular about the timeline for 1031 exchanges, and they give no latitude should you miss that deadline. Why are they stressful? Well, that's one of the reasons. The IRS gives very little latitude, but there are a couple of other reasons as well. Then we'll go through the timeline and show you a couple of basic examples of how a 1031 exchange can be used on rental property and potentially vacation homes. And then we'll go to our next advanced strategy, which is how can I 1031 a personal residence and combine that with Section 121 exclusions. And lastly, we'll talk about a second advanced strategy, which is how can I 1031 exchange not into a property, but a partial interest in a larger real estate project. All right, first of all, the disclaimer, I am not an investment advisor. All investments involve a degree of risk you should be aware of. Feel free to reject or accept any of the recommendations here. And in fact, I go Google it as well. All of this is easily discoverable online. There are tons and tons of good articles out there. As you know, there's no guarantees in investing, and consult a professional advisor. All right, what is a 1031 exchange? So a 1031 exchange refers to the Internal Revenue Code 1031. And if you actually go look it up, it's a little bit of a read, but you can do it easily in an hour or two. It's the section of the tax revenue code that talks about exchanges of like-kind property and how you can defer your taxes from your first property to the end of your second property, and even continue to do that on and on with multiple exchanges. The tax code enables the taxpayer to sell the investment property, which is called the relinquished property in the IRS code, with little or no tax liability, and to take all of the equity that was gained in the first property and transfer it over to the second property, deferring capital gains, taxes, and depreciation recapture taxes. So why is there a 1031 exchange? And I thought a little bit about including a short history of the 1031, when the key dates are for different parts of the 1031 code and when they came into existence. But the short of it is that 1031 exchanges have been around for a long time in the United States. They've actually been around since 1921, which is just 3 years before 1918, when the first federal income taxes were enacted. So they came into existence pretty close to the onset of federal taxes in the United States. And they've been modified. They were modified with the Tax Revenue Act of 24, 28, and 35. And then, of course, in the 80s, with the 1986 Tax Act, they were rewritten extensively. And then since then, there's been a series of case law that's refined what you can and can't do with the 1031 exchange. And so now the rules are fairly clear. There are people that specialize in doing this and helping you so that you can have an easy transition when you're doing a 1031 exchange. One thing that I'd like to say is that 1031 exchanges are not a loophole in the tax code. Loophole is kind of a messy term. People use it when people avoid paying taxes. But a loophole, at least in my opinion, is an unintentional consequence of the tax code. The 1031 exchange is a very intentional consequence. It's specifically there to provide mobility to funds within the market, so that equity that is trapped within buildings or houses that have been stabilized and are entirely fixed up can be moved to other properties that may need to be fixed up or may need to be stabilized. So it's a way of incentivizing investors to go out and improve properties. And that's basically why the tax deferred status exists, the federal government wants people to go out and improve properties, and they're willing to defer your taxes in order to let you do that. All right. So first of all, a point about tax deferred versus tax free. 1031 exchanges do not eliminate taxes. They only defer them. So the money that is in the relinquished property gets moved into the replacement property, and taxes are enacted at the end or whenever you sell the property through a non-1031 exchange. There is one case in which you can actually defer your taxes indefinitely, though, and that is if you happen to die before you sell your 1031 exchanged property. So at death, your heirs actually will receive that property. The capital gains and the depreciation recapture taxes are completely wiped out, and there's a step up in basis, meaning that the property that is received by your heirs, they will receive it at whatever the current market rate is at the time of your death, and they'll pay taxes with that as a starting point. So a lot of investors, what they do is, if they're cash flow investors, is that they will buy a property and they will just simply exchange it into a slightly better property, a nicer property. A lot of people that do rehabs will rehab a property, create equity in the property, take that equity, exchange it into another property that needs to be rehabbed, create equity there, and they'll just build it up. And so this is actually a very common strategy, and it's a great way to build, a real estate portfolio that pays cash flow and avoids capital gains taxes.
Hey, Daniel, quick question. Does that
Any questions there before I go on to the steps in a 1031 exchange? All right.
Yeah.
So the steps in a 1031 exchange. First of all, an investor is going to decide to sell their property, and they need to do a 1031 exchange. So before you sell your property, you need to have in mind that you're going to be doing a 1031 exchange, and you need to contact certain people, such as the qualified intermediary, in order to set up this exchange before you sell. It's critically important that you do that before you sell, because if you sell your property and receive the money for your property, the IRS will automatically disqualify you from being able to do a 1031 exchange. All the proceeds from your property will be taxed at normal capital gains or income tax rates, depending on your situation. So when you're doing this, you need to go and contact a qualified intermediary. And there are a lot of them out there. One of the most common ones is IPX 1031. They're a subsidiary of Fidelity. I've heard good things about them. I've never used them personally. But there are quite a few of them out there, and there's a lot of good education out there as well. The other thing you need to do is you need to have a replacement property in mind by the time you sell your initial property, your relinquished property. And the reason why that is because there's a very strict timeline that you have to adhere to when doing a 1031 exchange. So you'll place the investment property on the market, you'll accept an offer. When the property is sold, you have 45 days to identify up to 3 properties that might replace the property that you have just sold. And so within the first 45 days after close of escrow on the sale of the relinquished property, the investor identifies 3 replacement properties, up to 3. And this is known as the identification period. And during this period, I've got a timeline a little bit later on in the slide deck, but during this period, you can actually identify as many properties and change them as much as you want. But at the end of the 45-day period, you cannot have more than 3. And they have to be, of course, identified in written notices to the qualified intermediary. After that, you've got 180 days to close on one of those 3 properties. If you're not able to close on one of those 3 properties and you have to go with a 4th property, then your 1031 is disqualified and you pay full capital gains or ordinary income tax. But if you buy one of those 3 properties, then all the equity that's in your relinquished property moves over into your replacement property, and you're able to, use it to purchase and or fix up the property.
Hey, Daniel, can I ask a question there?
All right. All cash.
Daniel, you went mute.
All right, I'm gonna try something. There we go. Daniel, if you can hear us, you're muted, and it doesn't seem like you can hear us.
Hi, can you hear me?
Yes, we can hear you. Can you hear us?
All right, I can hear you.
Okay.
I don't
perfect.
know why it's I'm only guessing somebody's muting me. If you're going through and muting people, can you make sure you don't mute me? How long have I been silent?
Not too long, maybe.
Just like 30 seconds or a
yeah,
minute.
Okay,
something
good,
like that.
good.
Yeah.
There's
Hey,
been
Daniel.
questions, so yeah, go ahead.
Is there a question?
Yeah, I was just going to say the same thing. There have been some questions that people were trying to interrupt you. You weren't able to hear us.
Hey, Dennis, would you be willing to moderate and look for the questions and interrupt me strategically for them?
Sure. Let me see what I can do.
Awesome. All right. I believe that I was on this slide. Can I just start on this slide?
Yeah,
Yeah.
that's where we lost you.
Okay. So there is a rule of thumb called the 95% rule and the 2,000 or 200% rule. And that is that the value of the replacement property cannot be less than 95% that of the relinquished property, and it can't be more than 200% of the value of the relinquished property. And if there is a difference between the price of the relinquished property and the replacement property, then any money that is not put into the replacement property ends up being taxed at normal capital gains rates or income rates, depending on your situation.
Hey, Daniel.
So, yes.
There's actually a question right on that.
Okay.
So Louis is saying, I read that the government is looking into limiting the amounts you can carry over to a new property using a 1031 exchange. I think they're proposing to limit it to 500K. Have you heard anything about that?
There's lots of talk about it right now. New changes in tax policy. And feel free to look into that and follow it. But my general philosophy is, I'm going to continue to operate with the current environment until it's changed. But there is quite a bit of talk about changing it currently.
Got it.
I personally don't think it's going to happen, frankly, because a lot of our politicians own a lot of real estate. So that's my take on it.
So,
And
so,
a
so
couple. Yeah, go ahead.
sorry, like is the cash proceeds, is the difference, like is the profit, is the cash proceeds, or is the whole sale of the property?
So when you get rid of your relinquished property, the proceeds that come in from the seller and from the seller's financing are going to pay off the old loan, and then the proceeds that are left over, the equity that's in your first property, that's what gets moved into the second property. And if not all of that is able to be used in the second property, and I've got a couple of examples coming up, then the part that is not able to be used is taxed. All right.
All right. There are a couple more questions in the chat. Is it right to assume that 1031 is only useful if your gains on the property are more than 250K for a single person or 500K for a married person?
So you're thinking of IRS Code Section 121, which is exemptions on primary residence. So that actually is a separate section, and we're going to get to that in our advanced strategy number 1. How do you combine a 1031 exchange and a Section 121 exemption? So the 1031 does not place any limits on the amount of capital that can be moved. It could be, a very small amount, or it could be a very large amount.
All right. And then the last question in the chat is, does the replacement property need to be in the same location?
Absolutely not. And that's one of the benefits of this, is that, if you are tired of managing your property, or if I was just talking to some friends who were up in Washington last week, and they had 8 houses that they had acquired over the last 10 to 12 years. and they were 1031ing them. In this particular conversation, they were 1031ing them into syndications. And the reason why they were doing that is because the syndications were not in the Washington area. So they were going to go from, they were putting about $2,000 a month into their properties, meaning their expenses were higher than their income. And they were changing them to properties that were managed by professional managers, and they were in other parts of the country that were cash flowing. So it was a great situation for them. They don't have to be in the same area. They just have to be in the United States. And maybe I shouldn't even make that claim because I don't actually know that that's true. They don't have to be in the same area.
All right, thanks, Daniel. That's all the questions for now.
Okay. All right. The purchaser of the replacement property must be the same as the seller of the relinquished property, or it has to be their LLC or business entity. So a disregarded entity is usually an LLC that you'll set up for asset protection purposes. You know, if somebody slips and falls on your property, you want the person that is suing to take from your property and to protect your personal assets. So a disregarded entity lets you do that. But for tax reasons, the income that comes into the disregarded entity is passed through and it's reported on the individual's tax return. So the relinquished property has to be purchased by the same person or by a disregarded entity that is owned by the person or married couple. All right. More rules for the 1031 exchanges. In order for safe harbor protections, you have to involve a qualified intermediary. And a qualified intermediary is a financial institution that will basically set up an escrow account so that when the proceeds from your relinquished property are sold, they'll go to this escrow account and you as the individual investor never have access to them. You're not allowed to have access to them. You're not allowed to use them in any way whatsoever. In fact, the funds legally are the qualified intermediaries and they are holding them on your behalf. And in fact, one of the ways that they make money is they make money on the interest of the funds that they are holding for you. So they keep the interest, but at the end of 180 days or whenever the replacement property is purchased, you know, those funds are released back to, you know, you. Funds from your sale are held by the QI and then transferred to the replacement property in the transaction. The other rule is that you have to purchase what the IRS terms a like-kind property. And like-kind in terms of the IRS means that the property is used for investment purposes or potentially business investment purposes. But it is not a vacation rental home that you use. It's not your personal residence. And there are ways to change your personal residence to an investment property and vice versa. But like-kind in this case just means that it's an income-producing property. So what types of income-producing properties can you potentially exchange in between? Well, you can take a single-family home and you can convert that to air and water rights, or you could take a commercial office and convert it into a multifamily apartment, or you could take vacant land. This vacant land is actually an interesting use case. There's a variety of rules around what types of improvements you can do on the vacant land. So there's some extra rules there with it, as there are extra rules with oil and gas and air and water rights and Delaware statutory trusts. But in general, as long as you adhere to those additional rules, you can exchange in between your single family home resident and a commercial office, a retail building. And the other really interesting one here, which will be advanced strategy number 3, is you can exchange it into a tenant in common property. And what that means is that you can have a partial interest in, say, a large retail center or an apartment complex or a commercial office. So you might exchange your single family rental home for a 10% ownership interest in a shopping mall or whatever it happens to be.
Hey, Daniel?
Yeah.
There's another question that came up. Do the intermediary charge anything for services, or is it just an interest on the amount? That's the only gain for them?
Yeah, there's actually 3 ways that they get paid. They get paid at the beginning, during, and at the end. And it's fees. The fees are usually fairly nominal. They'll be $500 to $1,000. It's kind of like a title or an escrow company. So they'll charge a fee for processing your papers, for making sure that they're on the line with your lenders and other people that are involved. They'll also take interest from holding the money during the time, and then there's usually fees at the end. So it's usually not a very large amount. Specifically, if you've got $100,000 or $200,000 worth of equity in your property, it's fairly minimal.
All right, thank you.
All right. So 1031s can be stressful. It can be hard to find properties that pencil out or are worthwhile investments in the 45-day initial time period. Your local market, going back to somebody's question earlier, might not have any cash flowing properties. So you might have to look, out of, well, I guess you can still buy in your local market, counting on appreciation rather than cash flow. But you might want to consider looking at other markets. Working with banks to qualify for loans is always kind of tricky. Banks are picky and fickle, and they can be somewhat arbitrary a lot of the time. Particularly when you're working with some of the advanced strategies. For instance, if you move into a tenant in common interest where you're exchanging a property for a ownership interest that might be 10% of another one, you do have to get into things like the lender will have to bifurcate the loan, where the loan for the larger property, 90% goes to the other tenant in common and 10% goes to you. So there may be some tricky lending conversations that you'll have to go through. All right, catch-22 for real estate investors. Buying value-add properties is a lot of work and time and money. And if you're buying a turnkey property, there may not be very much equity left in it. It might be that it's entirely fixed up and you're just receiving the cash flow that's coming from it. All right, here's the timeline. It's fairly simple, actually. 45 days, that's the time period that you have to identify up to 3 properties that you will exchange, and 180 days to actually complete the exchange. This 45 and 180 days are not exempted for any reason. Your 45 or 180 day period might end on Christmas or Hanukkah or whatever holiday. It does not regard weekends. It does not regard holidays. It does not regard any sort of interruptions. It's always 45 and 100 days.
Hey, Daniel.
Yeah.
For the new properties, the ones that you say would be listed during the identification period, do those have to be listed in an MLS and publicly available for sale, or could they be, let's say, a private deal that you're setting up?
Yeah, they could definitely be a private deal. Just any real property. And by real, I mean real estate property.
Thanks.
All right, example number 1. Let's say that you want to put more cash into your replacement property so that you can improve you're improving your property. You're going from a relinquished property to a better replacement property. This is kind of the strategy of exchanging up and letting appreciation move you to better and better properties. So let's say that you sell a property for $500,000 and you have a $300,000 mortgage on it at the time of sale. You choose to keep your debt level the same. This is actually something that I didn't mention yet. The debt that you have on your first property must be equal to or greater in your second property. So you have to move your debt over as well as your equity. So if you choose to keep your debt level the same, but you want to buy a $700,000 property, then you're going to need to add $200,000 out of pocket to buy the new property. And so you'll have $400,000 coming out of pocket. You'll have the same $300,000 mortgage, and this scenario would satisfy the requirements of a 1031 exchange. All right, so that's the putting cash into the deal to improve the property scenario. Increasing your leverage. So not only can you, in the first example, we were increasing the amount of equity in the property. You can also increase the amount of debt in the property. So a common reason to 1031 exchange with an investment property is to increase the leverage that you have on that property. When your leverage is increased, that means that less of your personal money is in it. So your return on investment, your cash flow, will be percentage-wise greater. So in this particular example, let's say that you dispose of one of your investment properties for $500,000. You owe $100,000 on your mortgage at the time of sale, and you have your eye on a property that costs $1.1 million. So you use $400,000 in cash from the sale, and you get a new $700,000 mortgage to acquire the property. So this would also satisfy the requirements of a 1031 exchange. All right, and then partial exchanges. So if you buy a property for a lower sales price than your original property sold for, so in this case, let's say you have an investment property of $600,000 and you have a $350,000 mortgage. You buy a property that's less in value. Now this is lower than the 95% that I mentioned earlier. And you carry your same mortgage over. That means that you're going to receive $100,000 of income. That income is taxable. So in this particular case, you can defer some of your taxes on the amount that went into the property, but the amount that did not go into the property is still taxable. And I want to keep my eye on the time. Okay, 12:40.
Hey, Daniel, I have a question
Yeah.
about example 1 and 2. In example 1, you said that the mortgage in the second home needs to be the same or less.
Greater.
It needs to be greater
Yeah.
or the same. Okay, got you.
I may have misspoken. Needs to be greater.
Hey, Dan, one question.
Mhm.
What about if the house is a new house that is being built? So you won't close until the house is almost terminated. How that will work?
The timeline does not change. The IRS never gives any exemptions to it. And I should say here, there's actually a couple of different types of 1031 exchanges. The one that we're talking about mainly here is called a time deferred or a forward exchange, where you're selling a property and then buying another one sometime in the future. And these came about in the 1970s after a case with the IRS in tax court with a family called the Starkers. And so this is the most common one. There's also a reverse where you can sell a property and then buy your other one later. And then the case that you're talking about here is when construction is involved. There is a construction 1031 exchange. And I am not terribly familiar with the rules of that. The rules are more complicated for the construction 1031 exchanges.
Daniel, there are a couple of questions in the chat. The
Yeah.
first one is, if you have two legal entities, can you sell from one to the other and refinance as a result?
As long as they're both disregarded entities.
So like two LLCs or something?
Yep. Two LLCs that you own and the income is being passed through to you. And again, consult a professional. They may have ways of, changing or getting around that. There are legal structures that you can set up to enable those sorts of scenarios.
All
Daniel,
right.
one
Go ahead.
quick question. Let's say you have identified 3 properties and you want to buy 2 of them.
Yes. You can actually put money into multiple properties using a 1031 exchange.
Got it. Thank you.
Yeah.
There's one more question. How exactly would the IRS know that I conducted a 1031 exchange if I held the second property for more than 5+ years? I assume that's,
What doesn't the IRS know about you? Yeah, I mean, all the banks report to them. So if you're using any sort of debt, the counties, they keep public records. They'll know.
All right, that's it so far.
Okay. So the 121 exclusion. Some of you might be familiar with this. I think a lot of people that have jobs at companies tend to use this, but Section 121 of the Internal Revenue Code provides that a property held and used by you as your primary residence for at least 24 months out of the last 60 months, so at least 2 years out of the last 60 years, can be sold, and you can exclude up to $250,000 of capital gains as a single person, or $500,000 as a married couple, or filing a joint return. So this exclusion can be used in conjunction with 1031 exchanges, and it is a little tricky to set up, but I think it's commonly done. And usually, if you want to do that, you should consult a tax professional. We'll go through and kind of walk through how that works.
What would you say if, so I've rented rooms out of my house. So actually I have a Schedule A and a Schedule E. It's a little complicated, but I'm a little weary about, there may be a period like a year where I'm not going to have a tenant now that I'm married. I'm just wondering if I fall under that 121 where I'm just exempt because I lived there the whole time. So it was kind of a rental, but it was kind of not.
Yeah, I would say find a specialist that'll give you an answer. I don't know. All right. So advanced strategy number 1. This is what I just described to you. In this scenario, your property has appreciated more than 250,000 as a single person or 500,000 jointly. So if you want to be able to exclude that amount from taxes, and then you want to be able to take the remainder of that and 1031 exchange it into another property. So you can do this, and this can be accomplished. It's an advanced strategy, but you'll save tremendously in your taxes if you can combine these two strategies together. All right, advanced
question.
Yes.
Is the 500K exclusion net of any renovations made?
It's depends on the sales price. So whatever you're able to sell it for.
Okay, so
and your cost, selling price and cost basis.
So I guess the question here is, if you bought your house for say 250 and you sell it for 500, if you've added $100,000 worth of renovations, can you count that as part of your cost basis?
I would consult a tax advisor on that.
Gotcha.
I'm going to say that a lot for this because a lot of this can be very tricky, and there can be specialist situations that occur. So it really is important to, get your particular situation looked at. All right. So combining the section 10. So in this particular case, you have a property and you want a primary residence and you want to convert it into a rental property, and you want to take the section 121 exclusion because you had a primary residence, and then the 1031 exchange when it is a income property or a like-kind property. So you can combine those two. You just need to make sure that you fulfill the living requirements that are set forth in section 121, which is living there for 2 years out of the last 5. Okay, and advanced strategy number 2 is the reverse of that. If you have a rental property that you've acquired through a 1031 exchange and you want to convert that into a primary residence and take both exclusions. So just know that that can happen as well. It was influenced a little bit by a decision that came down in 2004, where it was determined that you have to be there at least a minimum of 5 years in order to qualify for the 121 exclusion. But you can actually do the reverse process as well. So acquire a property through a 1031 exchange and convert it into a primary residence or a vacation home.
Question on the previous slide on the strategy 1. So it looks like the requirement to convert a primary residence to a rental property is just you need to be there for 2 years consecutively in the past 5 years.
I don't believe that it has to be consecutive, but 2 out of 5 years, yes.
Oh, 2 out of 5. That's the only requirement to convert a primary to a rental property.
Again, check your particular situation with your tax advisor.
Can I ask a kind of a related question?
Yeah.
So given I've been writing off depreciation and all the kind of stuff, given I was renting a room, and then I'm not going to have a tenant for a given amount of time. Now is the IRS going to come after me for the depreciation, the tax cuts that I got for upgrading my property, even though I'm not, basically I'm going from a partial rental to a non-rental, and I'm worried that all the tax benefits I got during that period of renting, that now the IRS is going to want their money back for. Does that make sense?
It does. It's called depreciation recapture. And that there are situations where you may have to pay depreciation recapture, and there are some situations where you might not have to pay it. And so one of the lights or benefits of depreciation recapture is that oftentimes the recapture rate can be reduced. So it's not necessarily a dollar for dollar recapture, but sometimes it can be 30 cents on a dollar, 40 cents on a dollar. So there's not necessarily a one-to-one recapture if you do have to go through that situation.
Does the IRS also include all the repairs and upgrades as part of that recapture, or is it just the depreciation?
I don't know.
Okay.
So I'd ask your advisor.
Okay, thanks.
I want to follow up on that question of his. The depreciation recapture only occurs during the sale of the property, correct?
Mm-hmm.
Okay. So if he wasn't planning to sell the property and
I am not. I'm worried
and he
about
just
the
has
tax.
it vacant, then he wouldn't get a depreciation recapture event, correct?
I'm worried about the next tax season. That's what I'm trying to say, because I'm not going to have a tenant in here anymore. I'm worried the IRS will be like, nope, it's not a rental anymore. We want our money back. But what you're saying is, nope, none of it's null and void until I actually sell it. So what I'm hearing?
Usually depreciation recapture happens at sales. Yeah.
Okay.
All right. Advanced strategy number 3, and we'll end on this and save a little time for questions. But advanced strategy number 3 is that from English common law, we get the tenant in common structure. And one of the defining attributes of a tenant in common structure is even though you and the other tenant are both owners of the property, you are deemed to have an undivided interest in the property. And that's very key, because saying that you have an undivided interest in the property, even though you are a fractional owner, means that you qualify for a like-kind exchange, where you're exchanging a property for a property. So one scenario which is actually explicitly disallowed by the IRS is you cannot change your real property into a partnership interest or a business fraction of a business or a stock or any sort of equity or security. I'm sorry, security, not equity. So the tenant in common structure satisfies this and allows you to take a partial ownership in a property. So why is this interesting or important? Because you can scale up into much larger assets. You could have a 5% ownership in a shopping mall, or 50% in a gas station, or a 10% in an apartment complex, or any other larger real estate that you want to own and benefit from the economies of scale of it. So you're able to increase your buying power. You're able to usually get professional property management that'll come along with it. Oftentimes these are passive, so the larger partner or the larger tenant in common will tend to be the one who is managing it. You can diversify into different markets. You don't need to qualify for the Fannie and Freddie lending. However, the lenders are going to underwrite you personally and look at your financial situation to make sure that you qualify. This is a confusing point here. It also makes it, there are a fair number of these investments out there, and so you can find them. They tend to be, if they're available, they tend to make sense from a business perspective, hopefully. So those are some of the benefits of going to a partial tenant in common structure. And I have there we go. I wanted to show you this. So this is what that would look like. You have 2 tenant in commons down here. One would be Shopping Center LLC. The other one over here would be you as a undivided ownership tenant in common. You might have 8% of the Shopping Center LLC assigned to you. And there could actually be multiple tenants in common. So maybe one tenant in common has 3% ownership, another has 5%. And these people over here qualify as the 70% of the ownership. And these here are like normal syndication investors, people that put money into the building and are passive. So all of these people are considered passive. Usually, since you are co-owners, there are agreements that are set up at the time of closing that of how managing works, how voting rights work, how all these different common business agreements are arranged. And then the general partners over here, they might have whatever percentage they happen to have, but they will be the ones that are actively running the whole structure. So something like this is possible. If you're interested in this sort of thing, you have to approach the people that have the shopping center ahead of time. If they've gone to their lenders and are setting up lending and are already bringing in investors, then it's already too late because the lending structure has already been set up. And this needs to be set up ahead of time so that you have a tenant in common structure.
Hey, Daniel, cool question.
Yeah.
So for the passive investors there, the partners, are they also on like the title thing on the contract, or are they on a separate contract and you just list them out? I guess I'm just trying to understand. Are they known to the shopping center and the other folks?
Oh yeah, they are known, and they are owners through a tenant in common agreement. They are also signing on the loan for the overall shopping center, so they are co-owners. And it explicitly in the documents, in the legal documents, it will explicitly say, usually the first or second paragraph of the document, that these people are not partners in the business; they are co-owners, and that's an important legal distinction.
Okay. So by saying that, then they're also protected because they're just passive investors versus actual partners, right?
They will still have to sign on the loan, which usually the passive investors do not need to do. So there are some differences between them.
Oh, okay. Thank you.
Yeah.
So Daniel, is this set up through syndication then, or because you said you need to approach the shopping owners ahead of time?
Syndication is one way of doing it. You don't have to syndicate over here. It's just an example.
Yeah.
These owners might just bring in 30% of the capital themselves and not syndicate any of it. So whether it's syndicated or not, you can still have a tenant in common agreement.
Okay.
All right. It looks like we're running out of time. If you could, I'm going to drop that link in the chat here one more time, just so that everybody has it. And hopefully it's still here. There we go. If you could you please go and fill out this form? It's just letting me know how you actually attend and how you get to this and what topics you want to hear in the future. So any other questions? Feel free to contact me at any time. I have open office hours, and I'll drop the link in here for that. Well, if you're interested in talking to me just personally, feel free to email me. And that's all I have for today.
Thank you.
Have a wonderful weekend,
Thanks,
everyone.
Daniel. You too.
Awesome. Thank you, Daniel.
Thanks, Daniel.
Thank you.
Thank you.
Okay. Bye.